In today's world of market volatility and uncertainty, your retirement plans need to be front and center. With ever-changing tax laws, healthcare worries, and an unpredictable stock market, don't overlook the vulnerability in your retirement planning. Protecting your family and estate will be difficult with shifting policies in Washington. It's more important than ever to keep an eye on retirement.
Hi, and welcome into this episode of Eye on Retirement, the weekly show that keeps you in the know about all things retirement. If you're one of our many regular viewers, welcome back. And if you're joining us for the first time, welcome in. We've got a full complement of panelists for you on this episode, to include Matt Goolsby, a financial advisor with Market Advisory Group, Tiffany Rayer, a tax advisor with Market Tax Services. We've got Trey Basa of Market Medicare Advisors, and with Eidelman Law Firm, our estate planning attorney, Gerald Eidelman. Welcome in, everyone. Today, this show is dedicated to viewer questions and listener questions from our weekly radio show, Retire Hour. Matt, it seems time and time again, and more so lately, I'm meeting with clients on a first appointment that are seeking more than what their current advisors are providing as far as good guidance and more complete retirement services.
You're exactly right. I mean, take, for example, where have predominantly most people saved for retirement? IRAs, 401ks, and those accounts have not had the taxes paid on them. But then if you're meeting with your financial advisor and you ask them a tax question, it's not uncommon for people to say, or reply with, well, we're not licensed to give you tax advice. We can't give you tax advice. Do you have a CPA or a tax preparer that helps you with your taxes? And maybe you can go get an answer from them. And that's not an acceptable answer for us around here. So we go down the hall and we grab a CPA or a tax advisor and bring them in the room, and helps us get answers in that moment to those questions that arise. But sometimes it's not just taxes. Sometimes it's estate planning. Do I need a will? Do I need a trust? Or oftentimes even Medicare. And this brings us to our first question that we have from a viewer. Her name is Kathy, and her last name starts with H. And I guess this would be a question for our Medicare advisor, Trey Basa. It's a fun name to say, right? Trey
It
Basa.
is indeed. Trey, Kathy wrote in and she said, I don't know if I can get a Medicare supplement in the middle of the year. I have Medicare Part A, don't have Part B because I'm still working. Please advise. Kathy H.
Okay, Kathy. So when we're working and making the move to Medicare Part B, that start date is what we really want to keep an eye on. We can get into a Medicare supplement plan any time of the year, 6 months from that Part B start date. From moving from workplace to Medicare, we really need to be aware of that timeline and when we are going to make that move. It can happen anytime. Just communicate with us when we're going to make that move.
So as far as making that move from workplace healthcare to Medicare, how much lead time should somebody have before they come talk to you?
In this instance, Kathy is kind of already in the system. She has Part A, so she has a Medicare card and a number unique to her. Now we just need to talk to the Social Security Administration. We need to update her card and get Part B effective date onto there. And then we can actually get everything started. Technically, you need Part A and Part B to have started before you move on to a Medicare supplement plan. But because we already have that Medicare number, we can already apply for Part B at the same time as the supplement plan and have those coincide with starting dates.
Thank you very much. Gerald, it's surprising to me how many people I meet with that have invested time and effort with their financial plans but don't have any kind of estate plan in place yet. What are some of the factors that you see when you meet with people in first appointments that have kept them from pursuing this important piece of their retirement plan?
Well, one of the biggest issues is the bugaboo of if we're going to do a estate plan, that means we're planning for death and we're going to die. I know it seems silly, but it's very common for people to put it off as long as possible because they are concerned about, they don't want to deal with death. So that's one of the issues. The other issue is sometimes people don't know what to do or what they're supposed to do. They don't understand, what the process will be, what they're leaving out if they're not having an estate plan, what a mess they leave behind. So they need to be cognizant of the impact that not planning will have on their heirs. And also, it's just sometimes certain individuals can't figure out how to divide up their assets. Some people are single, have no children, no spouse, may have extended family that they may or may not want to, leave their assets to, so they put it off. And of course, that could leave a real big mess for whoever winds up inheriting that asset.
Very good. Gerald, here's another viewer question. Diane S. writes, I inherited my home from my mother who passed away in 2018. A transfer upon death deed has been recorded with the Register of Deeds office, Sedgwick County in Kansas, and there remains a mortgage in my mother's name, a HELOC, line of credit, and the Credit Union of America is the lender in Wichita, Kansas. Yet they continue to deny me access or information about the account. I am the one making the payments, etc. Is this legal?
Well, this is an interesting question because she mentions mortgage and then the HELOC, which is a home equity line of credit. They're treated differently under the law. If you inherit a property with a mortgage, the lender has to allow you to continue making payments on the mortgage. That's not true with a HELOC. They can call the HELOC at any time and require you to pay the property or foreclose on the property to get their money back. So here they seem to be working with her, or she has not notified them that the mother has passed away. And if that's the case, the bank has no obligation to give any information out because she is neither the executor of the estate, because she got this directly through a transfer outside of the estate. She is not the borrower. So she's kind of stuck in this limbo that if she pushes too much, the bank could just turn around and say, okay, fine, and we'll foreclose on the home and we'll be done with you. So it doesn't give her a lot of opportunities to make anything happen. Now, one of the things I would suggest, and obviously this seems like an easy answer, but is try to refinance the property, either get a mortgage itself to pay off the HELOC, see, and this is very unlikely, see if the Credit Union of America will transfer the HELOC to her. That's very unusual. It's not likely to happen, but it's worth trying as well.
Matt, how do people do retirement without a whole team?
Not very well. And unfortunately, we find the case is where they realize they need something, whether it's tax advice, help with their Medicare plan, help with their estate planning, settling things, whether it's from their parents or maybe just a spouse, or maybe they decide to get remarried. All these questions come up, and unfortunately, when we meet people, when do we meet with them? It's after something's cost them a bunch of money or something's come to the light. It's like, whoa, we got this $30,000 tax bill, or they won't talk to me at the bank, or I went to the doctor and they're not taking this plan. That's not the moment when you need to be getting answers to questions in your situation. You want to work with a team that can navigate those situations to say, hey, what was the gal's name? Her name was Diane. Diane, before your mother passes away, we know you've been taking care of your mother. You might want to make sure you have this, this, and this addressed. And as your financial advisor, I can't help you with that, but guess what? We have estate planning attorneys that we can walk down the hall, grab and bring into this conversation and get answers in real time.
Do you have a whole team looking out for your best interest? And if not, what piece of the puzzle might you be missing that could end up costing you or your heirs money down the road? At Market Advisory Group, we provide that team to assist you in your retirement planning. from estate planning to financial planning, as well as tax planning and Medicare advising. And we do it all under one roof for your convenience. If you'd like to set up a complimentary no-obligation consultation, operators are standing by right now to take your call at 316-252-8707. And be sure and check out our website at ionretirement.com. There you can view past episodes or submit a question for possible use on a future show. We'll be back with more viewer questions on this episode right after this.
When people work with Market Advisor Group, they get a feel of sense of family. There's a lot of relationships that are made and going on in this conference room, and we really take a lot of pride in that and a lot of satisfaction in that.
Every client we work with, we make a custom-made plan to fit them and help reach their goals in life. Another thing that makes us unique is we want to meet regularly with our clients and have reviews.
Market Advisory Group, we have a process, and the process we take people through is first to understand what they have, understand who they are, and then we put together an income plan for them and show them how they can look forward to retirement and not look, though retirement is going to be a stressful time. It needs to be a stress-free time.
A few unique features of working with Market Advisor Group is holistic in-house financial consultants. We've got an in-house CPA, Joshua, an in-house estate planning attorney, Gerald, an in-house Medicare advisor, Bill. We rely on all of those professionals for, again, additional service within our consultative process, making sure that we've got the advice and the expertise behind the recommendations that we make.
You know, as an advisor, I'm not there to sell them one way or the other. I'm there to educate them, to let them know what their choices are. Then I try to help them make the right choice where they can save money and feel confident in their decision.
Absolutely the best part of my job is getting a stack of paperwork from somebody and they don't know what to do, and then I can turn around and give them back a tax return, but also to be able to explain what they can do next year that will give them a better answer than what they had this year.
When we've got clients that are calling and they need to help out a child or need to help out a grandchild or need to help themselves out and they're in a situation they didn't expect to be in, I really relish the opportunity to help them through that, help them make the educated decisions in somewhat stressful situations, because a lot of folks don't have that type of counsel.
We meet with so many people one-on-one in this office that don't ever end up becoming a customer or doing business with us, and that's okay. But when they leave our office, we know that we've helped them either get some answers to some of the questions they had or get some clarity on maybe their own path.
But one of the things that we hear all the time is, I wish I would have met you guys 10 years ago, because how much further could I be down the road? Well, Johnny Appleseed said, you know, when's the best time to plant a tree? 10 years ago. When's the second best time? Today. And so if we can help people today going forward, that just brings an incredible amount of comfort and excitement for us to come to work every day.
Hi, and welcome back into Ion Retirement. Continuing this week's theme of viewer questions, Matt, this next question comes from Tim B. And Tim writes, in retirement, there is the possibility of making many mistakes or less optimal means of doing things. In your opinion, what are the top three?
You know, that's a really good question. And Tim, I'm glad you asked that, because most people really aren't asking those kinds of questions until after the fact, and when something's cost them a bunch of money or when something's bad has happened to them. Probably the first three top important things to learn or to focus on before you retire, I would say is, specifically if you're married too, is when and how to take your Social Security. There can be different claiming strategies out there, different factors to consider, your longevity. My dad's mother, my grandma Goolsby, she had cancer and she passed away early on. But both my grandparents, they were going to wait to take their Social Security until later and get the highest benefit at age 70. But it turns out my grandmother didn't reach 70. And since hers was the lower benefit, when she passed away, that essentially was gone. And of course, my grandfather would have rather had my grandmother, but there really wasn't a lot of consideration there in that part of that thinking of their plan. Second thing I would say is tax planning. You don't want to just worry about taxes today. And yes, we all think about, well, gosh, I mean, I'm paying so much in taxes, or how do I avoid paying so much in taxes this year? Is there anything I can do? But you also want to look to the future. Again, back to married couples. If you have $1 million or $2 million in your retirement accounts and you lose a spouse and you're needing to supplement the losing or the loss of that Social Security check, then you want to say, well, how much in taxes will that surviving spouse be paying? I mean, I don't want to get too much in the tax lane here, but as our tax advisors and CPAs tell us, a married couple this year, I think the top of the 12% tax bracket is around $89,000. You lose a spouse, if you need that same $89,000, well, now the top of the 12% tax bracket, when you're filing single the next year, now it's around $45,000. So if you need that extra $45,000, you're paying 10% more in taxes, and you've lost a Social Security check. So don't wait until these things happen, and then you're like, oh my gosh, what's this going to do to us? And then lastly, I would say estate planning. A lot of people, like Gerald say, they don't want to focus on their demise or what's going to happen when they're gone, or maybe they just think they're going to live forever. Wouldn't that be nice, right?
That's right.
But you have to factor in estate planning and things to consider. So that would be my top three. When to take Social Security, tax planning, and estate planning. I hate to leave you out Medicare, but the top four things are make sure you get your Medicare decisions picked before you arrive at that time of needing Medicare.
Well, since you brought up taxes, this next question is for both you and Tiffany, and it's a prime example of why having a team working for you in retirement is so important. Ava J. writes, I have a retirement account that I've paid taxes on up front. I'm interested in moving this account to my TSP account that I have with my employer. Is that something I can do, and how will the tax situation work? Ava J. Matt, what say you?
You want to go first?
I can. So
ladies first.
Okay.
Anytime that an employer offers a chance to get on board with like a thrift savings plan, that is always advantageous for you and the company, because you're in effect, especially if they're doing like a contribution match, which I'm assuming would be the main motivator behind that. However, if you've already been, Ava, proactive in contributing pre-tax to a retirement plan, then you have to really weigh out the benefits and figure out what would the cost be of you transferring that money over to a plan that's now going to start accruing tax liability. And you also have to take into account that you're going to be starting to probably increase your withholdings, and you need to start thinking about how your fluctuation in your income, which you've already done by
saving for retirement. That's what the whole goal is, right? Saving for retirement. Well, when she says pre-tax, though, she says, I have a retirement account that I've paid taxes on up front. Would that mean like a Roth, one of the tax-free accounts?
That's what I think that, I mean, that's would be what she would, I'm assuming that's what she did. Another thing you have to think about, though, when you are investing in an employer plan, then you also are giving up, in a sense, a little bit of control, too.
That's true.
And something with the future, if something were to go awry and your employer is now in control of that, then there's usually a little bit less diversity as far as hedging in the market sometimes, because the Roth tends to be a little bit wider span.
Well, yeah, and in this scenario, what comes to my mind is I had someone in the office the other day, and Joshua met with me and them, and he wanted to roll a plan into his thrift savings account because he could take a loan from it. Mm-hmm. So, because in an IRA, he couldn't take a loan from it, but the employer plan allowed him to do some loans that helped him control some taxes, right?
True, and it's very individual based. So Ava might have some particular situations where she could be not penalized if she's in a situation where she could already withdraw from her IRA.
Previously, before rolling it into that employer plan, because if she rolls it in there, then she might be limited to whatever objections are the plan there. Mm-hmm. You're starting to get in my lane. Maybe you want to be a financial advisor. But she's right. There are pros and cons to everything you do in life. And if Ava rolls this into her thrift savings plan, which is typically with the federal government, I mean, whether you work for either the postal system, maybe the VA, or maybe the military, those can be different participants that participate in the thrift savings plan, or TSP. And normally the good thing about a TSP is they're very low in fees. They don't have a lot of fees. But to Tiffany's point, what she said was you don't have a lot of investment options. And if you're looking for more discretion there, it might be more advantageous to have a conversation with a financial advisor to see what options you'd have out there. But again, if you're still fairly young, saving for retirement, it might not be a bad idea to roll that into the thrift savings plan. Although I don't think they can match on, if she's rolling that in, and it's a Roth, you don't get the matching dollars on the Roth dollars. That's just the after tax.
It's just going forward. I would maybe suggest keeping your money and
having more control of it.
And then just starting from here on, contributing to the TSP through your employer, because I would take advantage of that if they are matching. So
good point.
Many of you out there probably have a financial advisor, and some of you probably have both a financial advisor and a CPA that you work with. But do they all come together around one table with you to work for you in your best interest? If not, you don't have a whole team working for you cohesively. At Market Advisory Group, we practice the holistic approach to retirement planning, and if you'd like to set up a complimentary no-obligation consultation, operators are standing by right now to take your call at 316-252-8707. We'll be back with the final segment of the show right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Welcome into the final segment of this episode of Eye on Retirement as we keep our focus on viewer questions that have been submitted to us. Matt, the next question comes from one of our Missouri followers, and it says, we live in Missouri in a rural area and would like to know if a review of our investments can be reviewed without coming into your office and done on a Zoom meeting or any other options you might offer. That question comes from Michelle L.
That's true. We do smoke signals. We do Western Telegram, or what? No, I'm kidding. Yes, of course. We want to make sure that we're meeting and talking with you, however convenient it is for you. And if you cannot come in any of our offices across Kansas and Missouri, whether that's the Wichita offices, the Prairie Village, the Independence, Missouri, the Northern Kansas City offices, any of those offices, we want to make it accessible to you guys. I had someone the other day from the radio show, and they lived in Colorado. We did a Zoom appointment. There's certain ways we do that, and so if you have those questions, you can give us a call, and we'd love to have that conversation with them.
Okay, Trey Basa, Market Medicare Advisor, you're up. Cheryl P. wrote in and she asked, hi, my husband and I will both turn 65 next spring, and we're getting paperwork to sign up for Medicare. We will still be working with no plans to retire as of yet and have no idea what we need to sign up for. Do we just need to sign up for Part A and D? And that, again, comes from Cheryl P.
Thanks, Cheryl, for the question. As far as working, you continue that workplace insurance. You don't need to sign up for any part of Medicare. There is some paperwork that we need to do in order to get you onto Medicare with no problem. That's the CMSL 564 and 40B. Just throwing that out there. A little bit of alphabet soup for you. But those are papers that we need to fill out in part with your HR rep in order to make sure you move on to Medicare as seamlessly as possible. If you want to, you can sign up for Part A, but the Part D is not necessary.
Very good. Matt and Tiffany, Johnny S. sent us a question, and it says, I'm on disability, I'm 59, my wife passed, leaving me a little 401k that I rolled to an IRA. Will I get the same money at 62 or 65 switching to Social Security? And when can or do you draw from an IRA? That comes from Johnny S.
Well, Johnny, first thing I'm going to tell you is that what I heard there is you're looking at Social Security as early as age 62. If you've lost your spouse, you could be eligible for Social Security benefits or widows or survivors benefits as early as age 60. But if you're still working, there's some income limits you need to keep it under, and that's working wages. That's not withdrawals from your IRA, pension income. That's anything you're getting a paycheck on. And that number, I believe, this year is $21,240. If you go over that amount, there's some penalties. But I'm gonna defer the tax questions to our tax advisor on those retirement accounts and things like that, to Tiffany.
Well, there's definitely some stipulations to withdrawing if you were to withdraw early. However, if you are disabled, there usually is you are allowed to withdraw early penalty-free. So that is, you have that going for you, but your age is actually kind of a magic number on your distributions as well. So you could start supplementing your income as early as now with the RMDs, the required minimum distributions, aren't going to come into play until around 72.
73, right?
70.
Didn't they just change that? So many rules to keep up with.
I know. It's reading a book this thick.
That's all the time we have for this show. I'm Rick Everett, reminding you that we're here to keep an eye on retirement.
Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns are not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. Legal services are offered by Eidelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. The guest commentators featured in this show are not investment advisor representatives of Foundations and do not provide advisory services. Market Advisory Group does have several investment advisor representatives that can provide such services. This is not endorsed or affiliated with any U.S. government agency, the Social Security Administration, or associated with any federal Medicare program. All rights reserved.